You find a textbook breakout and enter long, but the price hits an invisible ceiling and violently reverses, wiping out your entry. This is the retail trap. The aggressive price action induces a fear of missing out, triggering a psychological response that makes a high-risk entry feel like a logical necessity. This highlights the core paradox of smart money concepts. The moments when a breakout looks the most convincing are often the exact moments when it is the least favorable to join. Institutional traders don't chase momentum. They operate on a spatial map, where every move is judged not by its speed, but by its location within a range of value. To navigate these markets, you have to stop looking for patterns and start looking for objective value filters. That filter is anchored by a single line, the 50% equilibrium level. This midpoint divides any price move into two halves. It is the metric that determines in real time whether an asset is objectively cheap or expensive. Standard support and resistance tell you where the price has been. Equilibrium tells you what the price is currently worth relative to its recent range. Over the next few minutes, we will map the mechanics of this 50% level, separate the concept of value from liquidity, and deconstruct why breakouts into a premium are statistically destined to fail. This anchor provides the necessary reference point. Without it, you lack the spatial context to distinguish between a genuine opportunity and an institutional exit strategy. Identify a meaningful structural move, a swing low and swing high. We calculate the midpoint by dividing the range. This 50% line is equilibrium. Everything above is the premium zone, where price is expensive. Everything below is the discount zone, where price is cheap. Smart money follows a strict rule of accumulation. They look for buying opportunities exclusively when the price is in the discount zone. For distribution, the rule is flipped. Large institutions look to sell or take profits only when the price has reached the premium zone. These zones are not static. As the market creates new structural highs and lows, the map must be redrawn to reflect the new range. Think of the value map as a living benchmark. It updates with every significant shift in market structure. If you continue using an old equilibrium level after a new high has been set, your spatial read of the market will be flawed. By mathematically restricting where you are allowed to trade, the value map forces you to align your entries with institutional behavior. Return to our breakout scenario. The price pushes through resistance with high velocity, sitting deep inside the red premium zone. Here, institutions distribute and close entries. While retail traders buy the strength, they are met by massive institutional sell orders absorbing that retail demand. This surge of retail buying provides the exact liquidity the institutions need to offload their positions at the highest possible price. Once the retail buying power is exhausted, the institutional supply takes over, and the price collapses backward toward equilibrium. Buying in the premium zone means you are paying the highest relative price for that move, leaving you with no margin for error if the market reverts to fair value. The setup felt safe because the candle was large and green, but it was statistically doomed because of its geographic location. Momentum is a trap when the spatial context is wrong. Markets naturally seek balance, which creates a magnetic pull that brings overextended prices back toward the 50% midpoint. Understanding the premium trap allows you to stop chasing momentum and wait for a structural discount. To use these concepts correctly, we must separate two terms that traders often confuse: value zones and liquidity targets. Equilibrium is a value concept, a spatial filter. Equal lows and highs are a liquidity concept. They are flat levels where retail stop losses cluster, creating a liquidity pool. Algorithms target these pools, spiking below the lows to trigger stops and fuel a reversal. The difference is critical. Equilibrium tells you where to trade, while equal lows show you where the market might hunt for orders. Treating a 50% midpoint as a double bottom support level is a common mistake that leads to being swept out of a position. These concepts interact when an equal low forms inside the green discount zone. When a liquidity sweep happens at a discounted price, it creates the ideal institutional entry, capturing both value and the fuel to move the market. Conflating these concepts causes you to misread the market's intent, leading you to take entries where you should actually be sitting on your hands. We can combine these rules into a unified execution matrix to filter every trade you take. First, you must confirm the macro-level bias. In a bullish market, your focus is entirely on finding a reason to buy. Second, wait for price to retrace across the equilibrium line into the discount zone. Third, look for a point of interest, like an order block, within that discount. When the price hits this zone and sweeps liquidity, it bounces aggressively upward. This hierarchy is absolute. An order block in the premium zone is mathematically invalid for a long position and must be ignored. Quantitative traders use this exact spatial logic to build algorithmic filters that remove human emotion. Trading bots can be programmed with a strict, if price is less than 50% parameter. This hard rule prevents an algorithm from chasing a breakout in the premium zone, no matter how strong the momentum appears. Automation simply enforces the spatial discipline that human traders often lose in the heat of a live chart. Premium and discount zones dictate where you can trade, not the direction of the market. Aligning your location with structural bias is the only way to build a consistent statistical edge. We can combine these rules into a unified execution matrix to filter every trade you take. First, you must confirm the macro-level bias. In a bullish market, your focus is entirely on finding a reason to buy. Second, you wait for the price to retrace across the equilibrium line into the discount zone. Third, you look for a point of interest, like an order block or fair value gap. When price hits this zone and sweeps liquidity, it bounces aggressively upward. This hierarchy is absolute. An order block in the premium zone is mathematically invalid for a long position and must be ignored. Quantitative traders use this exact spatial logic to build algorithmic filters that remove human emotion. Trading bots can be programmed with a strict if price is less than 50.